different take on this whole country risk consideration for transfer pricing purposes. Sébastien?
Thank you, Philippe. Thank you, Noel. Thank you, Andrea. Indeed, we have not specifically worked on Amount B, but indeed we've worked and we have been working for a number of years on the matter of the lack of comparables. The lack of comparables is a barrier to the fair application of arm's length in a number of countries and a number of regions. And we felt back a few years ago that there was a limited amount of economic literature on the matter. So we partnered with a number of TPED members, university professors, and I'd like to cite them, Professor Bert Steens, Thibaut Roch, Professor Christoph Bösseling, Professor Matthias Petuchnik, to come up with some economic modeling to assess what were actually the determinants of profitability for these so-called transfer pricing comparables. And this has been a quite long journey because it has taken 4 to 5 years, and ultimately we've been lucky enough to be allowed to publish in the Journal of International Accounting, Auditing and Taxation. And our work, or the assumption that we wanted to confirm, was whether or not we would find empirically that corporations operating in higher risk countries would show higher profitability. Intuitively, you would think that if you invest in a higher risk country, you expect as an investor or as the financer a higher return. So you have a higher expectation. There is a higher cost of capital. So the type of profit that you need to make should be exceeding this higher cost of capital. So the assumption that we were making initially before doing the empirical analysis, that we would find some correlation between the sovereign risk rating of a country and the profitability of companies operating in this country. So this is something that we've done. We've worked on a relatively large panel, and this is not overlapping with OECD work, because as Noel has described, Noel and the OECD have worked on distribution, so our panel is about manufacturing. The data dates back a couple of years ago, but it's still 50,000 observations from a number of companies and a panel worldwide. And what you can see in the graph is that we find consistent deviations and higher profitability as you go towards the higher country risk. So the data that is shown is in comparison with the AAA countries, and you could see very consistently that the corporations in A, triple B, double B, B, and even triple C countries would trigger higher profitability returns, and we've checked on the return on total cost and return on sales. So the empirical analysis that we've done is backed up by a number of regression analyses, econometric work. We've inserted a number of control parameters in order to ensure that the results would be as reliable as we could. But it was evident from our analysis that there was a correlation. And interestingly, and for those who are in statistics, we could also very well see that, in fact, there was no correlation between the regional aspect. For instance, Europe, there was no correlation between the profitabilities of firms operating in Europe with the fact of being in Europe compared to being in the US. In other words, the variable parameter corresponding to country risk was more statistically significant than the regional one. And that tends to contradict the current practice, where I think the whole market is structured around regional comparable searches. So I'm not going to enter into the details, but simply to say that I'm encouraging everyone to read and, if possible, comment our paper, which is public. And I'd like to elaborate a few takeaways from our research paper. The first one is that in the absence of reliable domestic comparable companies, foreign comparables should not be rejected a priori. We know that there are certain jurisdictions where there is a reluctance to use foreign comparables. We feel this is not appropriate, one. Secondly, there are merits to using foreign comparables from countries with a similar country risk profile. And that, in our view, is quite new, and we would be very open, obviously, to engage with all stakeholders who would be willing to engage with us, because historically, to the best of our knowledge, country risk was a side or remote adjustment performed by certain tax administrations in the world, rightly, but it was the country risk or the profile of the country of incorporation of the companies was not the main parameter. There were parameters around the region, pan-European comps, pan-Asian comps, about possibly the size, companies above a certain level, but country risk was not at stake for most of the comparable searches. Third point is that, and that's interesting and intriguing, is that selecting comparables that are operating in countries geographically close to the country of incorporation of the tested party, let's say the European Union for companies operating in Germany or tested parties in Germany, even though appealing and widely used in practice, seems to be less helpful. For instance, if you would compare Germany and Romania, the economic circumstances are totally different. The ratings, there might be 3 or 4 notches between the rating, the country rating of Germany and the country rating of Romania, though there is a practice of using European Union comparables as if we would be a consistent or homogeneous economic zone, which we are not. Finally, our results also suggest that in case there would be a need to use comparables, for instance, of Canada, US, or Australia, to benchmark operations in Nigeria, Ivory Coast, or Peru, our study tends to suggest that this is not correct, and that there would need for certain adjustment, and I fully concur with Noel that this adjustment is not obvious. This is not necessarily mechanical, so there might be a difference between what is done in the context of Amendment B and what should be done in the context of a specific negotiation between a tax administration and a taxpayer in a certain country. But still, our search tends to suggest, and that's also the practice of a certain countries, that's also known to a number of countries, that it's either non-comparable or that requires a certain adjustment. Finally, why we feel that those results are robust is that they are not transfer pricing results. First, it's a lot about common sense as well, as Andrea said. I mean, operating, knowing how companies operate in Africa or in other countries, that tells something about their level of risks and expected return. Second, so we inferred our results from economic modeling and empirical evidence. Very pleased to hear that OECD results tends to suggest the same direction. And finally, it's also about corporate finance, as I said. I mean, if there is an expectation of a higher cost of capital, we need to convert these corporate finance findings into our transfer pricing world. You want to ask a question?
Later, finish your, of course.
Sorry. I have last, maybe but not least, what we've suggested in various papers is that if we believe that country risk is a major indicator, and if we cannot find comparables in Africa, why not expanding to Latin America, Southeast Asia, or even Eastern European countries to find good comparables? And why this may be extremely powerful and productive, we've taken a case about Ghana, and the rating of Ghana is not correct because that dates back a couple of years ago, this case study, for cocoa processing, which is a major industry in Ghana. We couldn't find any relevant comparable, also because, as Andrea has mentioned, this is all about prices and not margins for this industry. But let's assume we would need to find margins. If you expand, so zero comparable in Ghana. If you expand to Africa, to Egypt, Kenya, Nigeria, South Africa, on countries which are more or less the same ratings, you would find 13 comparables, which for those who are in comparable search, they know that is not enough. But if you expand to the rest of the world, expanding to other continents, you have more than close to 500 comparables. Why this is useful is because if you do so, you avoid the need to do the mechanical country risk adjustment. And I'll stop there because I took too much time, as expected.
As we all knew. Great. Thank you, Sebastian. I think here the idea, if I'm getting this whole drift right, we're all trying to find paths to not simplification but to accuracy and to basically negotiation positions that are principle based. Now, a question to you, Sebastian. A very short answer, probably, is in some industries when we look for, let's say, pan-European comparables, because some industries have been so much consolidated in, let's say, Western Europe, we end up with Eastern Europe comparables in many instances, which are countries which can be triple B minus, and below. Are we suggesting here that actually we're overcompensating countries like in Germany and France by using those comparables?
What I think is that it has not been proven that those comparables in Hungary, Romania, Poland are superior in terms of comparability than similar comparables in Australia, Canada, or the US.
Sure, the answer as expected. I think one of the things that we're trying to just throw here for discussion is country risk adjustments are good proxies. We know it. They're made on capital and on expectations of capital. But we also saw at the very beginning with Andrea that actually there's not necessarily functional differences, but the risks, the intensity of some risks might be different. And the benefit of an approach suggested by the TPET research is indeed that we're taking into account those risks and how they effectively materialize in the accounts of the entities, in their turnover, in costs, without any further proxy. And we reserve the use of the proxy, the country risk adjustment, using same risk adjustment on capital, just for those that we cannot approach. So that's, I think, two paths that are parallel in a way. We're not trying to achieve the same thing. We're very modest in our research compared to the gigantic exercise you guys have embarked on for 13 years, from the launch of BEPS to now to landing the pillars. We're trying to we can open for a few minutes some questions maybe you would have, maybe to the board. Romero, sorry for correct, he's not here, so I completely forgot. Now the issue, for example, is a very practical case here, which is Brazil. Brazil enacted country risk adjustments in their new regulations in normative instruction. Has been very vocal about comparables, and I love Brazil because it just goes from one regulated margin approach to full blast economics, probably with its share of uncertainty, and that's where probably we need the insights of Romero here on what has been happening and what might still happen in Brazil.
Thank you, Felipe. Happy to be joining. Can you guys hear me okay? Very good. Well, I mean, as I was listening to Sebastian speak, it was like a film playing back in my mind since we founded TPED a few years back. This was one of the main reasons why we started the work. We knew how difficult the issue of lacking comparables is for developing economies. We knew that Brazil was going to embark on this journey, which is now full blast of alignment with the arm's length standard. And we knew that the issue of lacking comparables would also be relevant for Brazil, as it is for Africa and Asia and for many other around the world, regions and countries around the world. One of the issues that we expected would surface in the case of Brazil, which the regulations and the law and the regulations very aptly addressed, was exactly the fact that Brazil is a very large and closed economy and in a way very unique within Latin America. So if we were to replicate the historical practice of adopting regional panels of comparables for Brazil, we would probably not be interpreting and applying the arm's length standard rightly for Brazil. We would probably not have a good quality of a panel of comparables. So, finding in the evidence, in the empirics, and then finding also support in, let's say, the harder science of economic theory, to go broader, to not be limited to regional comparables, to not be stuck with the historical practice, would be important, would be necessary to get to the right answer. And even challenging whether or not to start off with global comparables or with pan-European comparables or whatever might be available, and using this instrument, this tool of a country risk adjustment. To what extent could this be more broadly used for a country which is very relevant, very large, where price is formed within a quasi-autarky situation, given how large and how close it is, where there's supply side for a lot of different sectors for a very diversified economy, and there's also demand side for in a very diversified economy. So it's almost like a little pilot, a little test tube for the concepts that we're discussing here, given the magnitude of the market and the diversification of the economy. So the idea was, given that we were expecting to be confronted with lacking comparables, lacking domestic comparables for the Brazil market, very broadly, not just for distributions, not just for what's in scope of amount B, but for manufacturing, very heavily so, because we do have a large manufacturing base here, and even more broadly, given how diversified the economy is and how much, let's say, cross-border investment Brazil has had for the last century. So there's a very large stock of FDI sitting in Brazil and growing or not growing, but for the last century. So all of the different sectors of the multinationals that are in scope for the global pillars will be confronted with the question of how to price for the Brazil market, given a likely scenario of lacking comparables. So with all of that, the authority here, in a very, let's say, well organized, well governed process, with the immense support and collaboration of the OECD staff in general, Thomas Balco and others in his team, Cecile in particular, but they really paid attention to the work that has been done within the OECD, within TPAD, and more broadly on this issue. And very aptly, they brought the acknowledgement of the need to consider foreign comparables as normal, as ordinary, in the course of coming up with a panel for Brazil. So very explicitly in the legislation, there is already the foreseeing of the use of comparables that might be more readily available, more reliable, that you can depend on in terms of the facts and circumstances and the delineation of the transaction, rather than the shortcuts of what me closer geographically or even within the country. So the use of foreign comparables is regulated, is provided in the law. In using the foreign comparables, what the law has done is basically incorporated the toolkit that we see in the guidelines, the most complete and the most up-to-date toolkit we see in the guidelines, for the kinds of comparability adjustments that might be needed, going from the very microeconomic level to macroeconomics, and even the possibility of country risk adjustment. So again, the law itself is not prescriptive. It does not impose the application of a country risk adjustment to every case. Quite to the contrary, it lists it as an open-end list of examples, a non-exhaustive list of examples of comparability adjustments that may be needed. And then in the regulation of the general provisions of the law that came out more recently, the issue came up again. There was a lot of nervousness, as you all can anticipate, of whether Brazil would indiscriminately apply counter risk adjustment in every scenario. And the authority, even though verbally repeatedly has asserted that it will not, it will be depending on the old functional analysis, now on the delineation of the transactions, on the facts and circumstances of the case. But still, when and if it would be appropriate to apply country risk, what would the Brazilian authorities think would be the right approach, was a question that had to be answered. It was useful to see it answered. And then what the authority came up with in the normative instruction, in the regulation, is an approach which is sensible. Because first of all, not only is it in the form of a regulation, but it also brings a full-blown text, a narrative, which further contextualizes the rule, and some examples, much in the US style, which also is very helpful, very innovative for Brazil, by the way, but very helpful to deal with such a complex issue. And in the narrative, it again emphasizes that this is not a one-size-fits-all situation. That again, it's not limiting it or ring-fencing it to what might be the object of simplification measures under Amount B, but at the same time, it's not broadly imposing it in every situation where we're using foreign comparables. It's again saying, depending on the facts and circumstances, it might be appropriate to consider, among other adjustments, a country risk adjustment. And then the formula that is illustrated in the example is a formula that considers the difference in sovereign risk. So looking at government bonds, they didn't spell out which bond specifically they were using, but the economics goes in the right direction. So starting off with the sovereign risk spread and applying that to what the definition used was to capital employed, to a return on capital employed as opposed to a return on invested capital, for example. A return on capital employed considering fixed assets and working capital. My criticism might be working capital as a short for OPEX. We've discussed OPEX before. But still, it's in the right direction. So we're looking at what would the difference in return on capital be between Brazil and the selected comparables from the different countries. And again, not limiting them to countries with a similar risk profile. We could be comparing Brazil with AAA or with B. It doesn't matter. The point is that you would take into account that difference in sovereign risk in respect to a return employed, and then that return on capital employed would be transposed, for example, to a return on sales or whatever the profit level indicator would be used for the specific method. So the direction of the analysis seems to be consistent with what we've been developing. The care is there not to be overly prescriptive. The formula, of course, anybody can have a criticism or have a suggestion to make. I have mine. But again, it's very consistent with what we're discussing here, but it's very broad. It's not ring-fenced, as I said before. And we do fear that it might be, in practice, even though the narrative is there, it might be in practice overly adopted, just given the fact that comparables are lacking and that Brazil is an economy with those infrastructure issues that has mentioned before, with overall institutional risks that similar country risky countries have, that people might be overly applying, both taxpayers and even agents on the field, the application of this adjustment.
I'm terribly sorry, but we're running out of time. I think Sebastián still had a question on.
Quite all right. I was wrapping up.
You will never be disappointed by Brazil. They just go somewhere. They go hard. We were all surprised by how prescriptive the normative instruction was compared to the consultation ones, and I think there's going to be plenty of subsequent changes in the approach that we'll be probably discussing very soon. I'm just announcing it in the next webcast with TPED. Sebastián, you had a question, I think, for Noel.
Thank you, Romero.
Thank you, Romero.
Very nice to have you here. Next time you'll come to Paris to be with us, or we'll come to Rio de Janeiro. Very nice to have you on the panel.